You can imagine my jaw dropping. I just wrote this book, The Crash of 2016, that talks about how, the securitization of mortgages. What does that mean? Securitization of mortgages. It means that a bank goes out and they write $1 million worth of mortgages, or $1 billion worth of mortgages. And then they bundle those mortgages up. Now, those mortgages have a primary value, and they resell them to other banks. Okay, but they slice it into pieces, so the risk is distributed and diffuse and whatnot. And these are called tranches. So some other bank buys, let's say, a $200 million slice of that, and then they get insurance on that mortgage. Is it going to pay or not pay? And let's say they insure it 2-to-1. So now you got $400 million worth of insurance on the $200 million mortgage. You've now created $600 million worth of economic activity out of the original $200 million mortgage. Then they would find somebody else who would take a bet on whether the insurance was going to fail and do a 2-to-1 bet on that. So that $400 million becomes $800 million. And, and the process goes on. And in 2006, we got to the point where there was $600 trillion worth of these kind of bets. And a lot of it got dialed back with Dodd-Frank, which was passed in the wake of the financial crisis and disaster and all this. There's some small attempt. We didn't bring back Glass-Steagall. We didn't undo even, frankly, a quarter of the damage that Phil Gramm did with his Enron bills in 99 and 2000. Graham Leach Bliley and the Commodity Futures Modernization Act. Didn't even do a fraction of that. But we at least slowed down in the United States, and thus for much of the international banking system, because our banks collaborate with other people's banks, slowed down this securitization. Securitization means basically, will you place a bet on this mortgage? The underlying mortgage is the security, right? And then we're going to bet on that. It has an underlying value, and then you derive from that underlying value the bet. Thus, they call them derivatives. So I'm looking at the Financial Times this morning, as I am wont to do, and no, they are not a sponsor of this program. It's just, I'm telling you, it's fascinating to read rich people talking to rich people. Although most of the people who write at the Financial Times are probably not rich people, they know for whom they are writing. And these two stories were side by side and they're there right now on the homepage. The first was, our regulators, Louise and I just went through this. Our son just bought a house, and it was like, whoa, all the paperwork. It was like weeks of paperwork, and just, it was incredible. Well, U.S. regulators, Tracy Alloway in New York writes for the Financial Times, have moved to boost the country's housing recovery. Now, I would say that's a euphemism for let's reinflate the bubble. Back to Tracy. By softening new rules. Softening the new rules? Really? That would force banks to hold a slice of packaged mortgage loans. See, it used to be that the banks had to hang on to a piece of it. So if they're going to sell all this risk, you remember Senator Carl Levin in the Senate committee where he was grilling, Fabulous Fab, the banker? And he was saying, now, you said in this email that these were, S-wordy mortgages, and you were going to dump these S-wordy mortgages on this person and that person, and you were laughing about it, and is that the case? And, only he was actually, Senator Levin was actually dropping the S-word on the air. And the guy was going, yeah, we were scamming people. He was, by the way, the only guy that was really seriously held responsible. The Jamie Dimons of the world, they just get another $10 million bonus. So, anyhow, the rule said that if a bank is going to sell his crap, they've got to keep a chunk of it themselves, and that will discourage them from making it really, really, really bad stuff. Because presumably they don't want to have they'll have real bad stuff on their books, but not really, really, really bad stuff on their books. So here's the story. U.S. regulators have moved to boost the country's housing recovery by softening new rules that would force banks to hold a slice of packaged mortgage loans. Used to be you had to put down 20% and you had to have what's called a debt-to-income ratio. In other words, they'd look at all your debt, your credit cards, your student loans, all that stuff, and look at your annual income. And if your debt was more than 36% of your annual income, they figured you couldn't afford to buy a house. And they wouldn't write the loan for you. However, Tracy Alloway in New York writes in the Financial Times, however, on Wednesday, today's Tuesday, isn't it? February 18th, August 28th. Oh, very interesting. The February 18th story. This is an older story. Oh, this is from last summer. Oh, this is fascinating. So they changed this last summer, but they still have... Okay, so great. Okay, now I understand the cause and effect. However, on Wednesday, the Federal Reserve and 5 other U.S. financial regulators suggested that qualified residential mortgages could include loans with a down payment of only 10% and a higher debt-to-income ratio of 43%. Okay, so they loosened things up since last summer. Have you noticed, by the way, that the housing market has picked up since last summer? So now there's more mortgages floating around. Now we get to the article that was just above that link in the Financial Times. That was the main headline. U.S. lenders return to securitized mortgages. And they talk about how this guy, Chris Haspel, who developed the new mortgage rules to prevent a rerun of the subprime boom. And I quote from Tracy again. This is today's paper. Now this is Chris Haspel, he is a part of a growing industry seeking to profit from making loans that fall outside the new qualified mortgage regulation that he helped author.
You're listening to the Thom Hartmann Program. Call 866-987-THOM.
She adds, this leaves a potentially lucrative opening for specialist performers such as hedge funds and non-bank lenders. Run!